Good morning, everyone. This is Jason Masters from Athene, and I welcome you to our Index Partner Report today with Barclays. Before we get started, a few quick housekeeping items to share. First, you'll notice that you're in listen-only mode, which means your microphones will be muted for sound quality. We will have a short Q&A following today's presentation, so please submit your questions throughout, and we will get to as many of those as possible during the Q&A segment. We'll probably spend 10 to 15 minutes there. Lastly, today's webinar will be recorded and sent out to everyone following. Thanks so much again for joining today, and I will hand it over to Lawrence Black, Index Advisor to Yale University Professor of Economics, Robert Shiller.
Thank you very much, Jason, and good morning to everyone. So today what we're going to do is two things. Firstly, I'm going to run through some of Professor Shiller's views and thoughts on narratives in the market and really what we see happening. And I'm going to highlight some of the key things that we think you should be aware of. And then secondly, I'm going to do a review of the Shiller Barclays Allocator Index and talk about some of the annual performance. And at the end, we'll take some time for questions that Jason will moderate. So now I'm going to go to the presentation and I'm going to turn off my camera. So the first thing I want to talk about is narratives. So this is what Professor Shiller is really thinking about today. It's the way he thinks. And his kind of view is that there are a number of economic narratives that impact markets. So let me give you some examples. If you think back to the 1930s when you had shoeshine boys giving stock tips, that's when you know the market is hot. You get people talking about it. You know, we can think about back to the NASDAQ bubble of 2000. You know, the taxi drivers were talking about stocks and pets.com and Amazon. So that's when you get these stories and they build into narratives and they eventually begin to move markets. And actually, you know, we're seeing that today. So what are some of the key narratives that we see? So I think Professor Shiller's view is, you know, obviously that COVID is a terrible impact and it's been an awful disease that has unfortunately touched many of us. You know, however, he's also thinking there are going to be some positive effects from COVID. And what he's really thinking is that, you know, we're going to leverage technology. You know, we're being a little bit less formal. You know, you don't have to drive to work. We can actually work from home. We can be spread out, and this is going to have some sort of changes a little bit on real estate. So, you know, that's one impact that we're kind of seeing, and you know, we're seeing some companies are going remote. So, you know, it is having an impact, and that's part of one of the narratives we see today. The second one is ESG. So ESG stands for environmental, social, and governance. And, you know, you may have heard of Greta Thunberg, who's kind of captured the imagination. She's a young Swedish girl who's done a number of publicity stunts, sailing into the New York harbor in a yacht because she didn't want to fly, talking about the environment. So we've seen this narrative is actually being pretty big in Europe. And a lot of the indices that we see in Europe now are actually ESG compliant. Almost every single index in Europe is going that way. And Professor Shiller thinks that this is, you know, it's catching on in America, and it's catching the public awareness. And what he really thinks is actually driving this is probably some of the wildfires that we've seen. You know, it seems for the last 2 or 3 summers, we have wildfires and they seem to be getting worse. You know, there is smoke from them. We're all kind of becoming much more acutely aware of that. And he's thinking, especially with young people, that this ESG narrative is growing. So, you know, what does that mean for you as investors? You know, it means that there's a lot of money flowing into ESG, and you know, the flows in the last couple of years have really gone from, you know, pretty small to multi-billion flows. So, you know, all stocks that are ESG friendly are kind of getting a bit of a boost, and stocks that are sort of not ESG friendly, you know, for example, energy stocks are kind of being a little bit less loved. Third point, real estate. So, you know, Professor Shiller is known for real estate. He has the S&P Case-Shiller home price indices. And I don't know if you saw recently, but in the most recent announcement in just last month, prices were up 19% year on year. So that's the highest in the year-on-year increase ever. So these home price indices actually focus on residential. And Professor Shiller thinks that the residential prices are, pretty high. But I actually think you have to begin to bifurcate when you think about commercial property. So firstly, you have to think about if you're in a red state, the blue state. Red states have seen growth. Blue states have seen a little bit more regulation around tenants and protecting the tenants. So that has differed. And I think COVID will also drive less demand for buildings, we think. But that's going to be nuanced. If people are going to come to the office less frequently, when they do come to the office, they want more of an experience. So they're going to want buildings with amenities and fancy gyms and fancy coffee bars. So prime commercial property may do well. Properties that have less of those amenities may do less well. So it's becoming a little bit bifurcated. But he does think that real estate is a little toppish. So one of his other key themes is sort of the roaring 20s. So we're kind of in that right now, we're in the 20s. But Professor Shiller thinks that there are a lot of similarities to the 1920s. So firstly, we're actually in the 1920s, they were coming off a pandemic. Think about the 1918 Spanish flu. And there's a number of similarities to what we've seen with COVID. So, the 20s were then people coming out of a pandemic. You had the sort of the tailwinds of the end of World War I, but we're seeing a lot of similarities. We're seeing sort of rampant speculation today, and again, we saw that in the 20s. In the 20s, the speculation was really in the stock market. Margin credit was high. A lot of people were buying stock on margin. Today, we probably see a little bit less speculation in the stock market, but that has morphed to Bitcoin and NFTs. So those are some of the similarities in sort of the markets. Also was a kind of interesting similarity in terms of technology. So if you think about it, in the 20s, radio was new, telephones were new. You also had fridges, which was a new technology to store your food. Even the railways it was quite a novelty. So if they had those new technologies, and today we've got our new technologies, we're sort of talking about VR and Facebook and all things like that. So we're in this sort of same time, and then obviously we have some of the new technologies around Bitcoin and blockchain. So Professor Shiller definitely sees some similarities between the 1920s and where we are today. His feeling for the equity market is, the speculation has not reached the same levels. Markets are high, as I'm going to sort of talk to you about in my next slide, but it's not as dramatic. So he's not ready to sell the US market yet, but he does think that it's getting toppish and expensive. So the other thing that I wanted to talk about was inflation. So inflation is important from a couple reasons. The first thing is inflation is one variable that directly impacts interest rates. Now, interest rates are obviously super important for fixed income and bonds, but actually the way I see it is interest rates set the tone for the whole economy. And I'll tell you why. Interest rates set the tone for equities because if you think about the way we value in equities, it's just simply a discounted cash flow model. You have to put a rate that you got a discount at. So your interest rates impact every single asset class. And what impacts interest rates? Inflation. So Professor Shiller is watching this very carefully. So, he kind of thinks that inflation is elevated. We've seen that. He thinks essentially inflation is going to remain high, may come back down, but I think we don't know where, but we do have a thesis that it's not going to come back down to the same low levels we've seen in the past decade. So why is this? Well, I think there's a couple things that we see happening. One is you've got this deglobalization going on. So where people have been onshoring their supply chains. So we've seen as a result of COVID that if your manufacturing facility was in another country, you couldn't get to it. You may have lost some of the critical parts. So you want to onshore some of that manufacturing capability. Secondly, we're seeing a bit of a decoupling from China. That's sort of some of the political rhetoric we see. And that will also drive some people to move factories to other locations. And we've actually had a sort of deflationary boom from China as they've exported their cheap goods to the world. And we've had those benefits probably for the last 20 years. That is probably over. And then, simply we're seeing, prices are going up. And, it's kind of like a global phenomena. I was interested to see the other day that Chinese manufacturers of soy sauce and oyster sauce, which are key staples in China, they put their prices up 7%. In Manhattan, when I get my hair cut, whereas where I'm based, they put up the prices twice in the last year. So I think we're all beginning to see inflation. And, interestingly enough, it's kind of creeping into some everyday conversations. I mean, I kind of wonder if anyone else is having these conversations at dinner tables, because that's really when it gets interesting. And the reason I think it gets interesting is because what you could have happen is what's called a wage price spiral. So what happens is, everyone feels like inflation is coming up. You start to talk about it, then you ask for higher wages. The employers give you a pay raise, but then in turn, because they've given you the pay raise, they have to raise the prices of their goods, and this sort of spiral can continue. So Professor Shiller thinks that hasn't quite happened, but we're kind of watching that. And one of the things we think you can watch is the average hourly wages. And you can see in the graph that it kind of has bounced around, but it's definitely looking elevated. The next point is the graph below, money supply. So, I think, there was a lot of misperception at the end of the great financial crisis in 2008 that the money supply went up, but it didn't really. But what we've seen now is the Fed really has been printing money since the onset of the COVID crisis. It obviously went up, it's kind of come down, it's stabilized now, but it still remains elevated. Now, as you know, the Fed are beginning to talk about the tapering process, so that's interesting. So we think that keeping an eye on the money supply and the average hourly wages is important. That could give you some early indications of really whether this inflation is sticky or not. And just to indicate again that inflation is important to watch, because that is going to impact rates, and rates impact every other asset class. So moving on to valuations. So Professor Shiller is known for the CAPE ratio, and the CAPE ratio stands for the cyclically adjusted PE. And how we calculate the CAPE ratio is the following. We take the price of an asset and we divide it by the average of the 10-year inflation adjusted earning. So the traditional PE, or price earnings ratio, is simply the current price divided by 1 year of earnings. Here we're dividing it by the 10 years of the inflation adjusted earnings. So what that does is that gives us a ratio that's much more stable. I mean, Professor Shiller says, why do we look at the 1 year earnings? The 1 year is at the time it takes the world to go around the sun. I mean, what relevance is that? So he wanted to look at 10 years to really look through the business cycle and see if something is cheap or expensive. So what we've done is we've tracked the CAPE ratios since 1881, and then we've bucketed them into groups of sort of less than 10, between 10 and 15, and so on. And what we see is on the extreme left, you can see when the CAPE ratio is very low, i.e. lower than 10, you can see equity market 10-year returns are pretty high. They look like they're in the sort of 14% range. Conversely, you can see when you look at the CAPE ratio is above 40, and it was the case when the NASDAQ bubble, it was 44, you can see that returns are negative. So where are we today? So I was just computing the latest CAPE ratio for Professor Shiller yesterday, and it's actually 39. So it is pretty toppish. Interestingly enough, the CAPE ratio got down to 20 in the low of the pandemic, and it's really increased radically. Now it's increased radically because there's been so much money printed. There's a lot of money out there, and it needs to find a home. And equities is one of those homes because bonds have had a great run as well. So equities have really been the asset class of choice, and that's why we're seeing some elevated CAPE ratios. How do the CAPE ratios compare to other key regions? So what I'm showing is a table of the key regions where we look at China, Europe, Japan, the UK, and the US. So as you can see, the US is 39. It was 31 in January 2020, so I want to kind of give you some context pre-pandemic. The long-term average since 1881 in the US is about 17, and the last 20-year average is about 25. So we are a little toppish. And what Professor Shiller and myself, we like to look at what we call the relative CAPE, where we take current CAPE divided by its 20-year average, and that's at 1.48. That gives us a way to compare if the US is expensive to itself. Now, we think you need to look at each country in relative terms, and I'll tell you why very quickly. The US has got a very different stock market to, say, Australia, which is very energy and materials heavy. So, energy and materials companies have different PEs structurally from, let's say, the US, which is very tech heavy. It's got much higher PE. So you can't really compare let's say, the USA CAPE at 39 versus the UK at 17, because the UK again has actually got a lot of minors in it. So you have to look at this relative CAPE. So looking at that for the other regions, we see that the UK is one of the ones that's cheap. It's kind of had a bit of a Brexit discount. Japan is probably is the cheapest at 0.77. Now, Japan, we do note that some of our data goes from the early 80s, and Japan was in a bubble in the mid to early 80s. If you recall, that the stock market was high. They said that the Japan's imperial palace was worth more than the whole of California. So they did have a bubble. So that's something to be cognizant of. Europe is 1.25, so kind of a little on toppish side. And China's interesting because China 3 or 4 months ago was at the relative CAPE was about 1.2, so it was quite expensive. And we've seen Chinese market has come down. Primarily, the price has dropped pretty dramatically as President Xi has kind of implemented his common prosperity. And we've seen the stock market, some of the big tech names like Tencent, Alibaba have really fallen in price, and therefore China is one of the cheaper countries. So what Professor Shiller does say within the US market, you can see that it's expensive at 39, but there is a way to access the US market by trying to identify cheap cheap sectors using the CAPE ratio, and that's what we do with this strategy I'm going to talk about next. So before I do that, I wanted to talk about forecasting. So what we do with Professor Shiller, he actually designed the CAPE ratio to forecast, and what we do is we sort of use the past CAPE observations. So for example, if it's 39, we look at the previous observations, we run a process called regression. We'll say, if it's 39, if we had to regress it, what would that forecast be? And when we do that, we see that in the United States for the next 10 years, we expect the S&P to return, from Professor Shiller's numbers, about 4.3. Europe, we see 4.2. And Japan, we see is actually probably the most attractive at 6.3. I think this is also quite interesting in that some of you may be aware that the S&P on a price return basis over the last 10 years has returned 14%. So the last 10 years have been a fantastic time for equity markets, the US in particular. And we see that returns going forward may not be those high teens, they may be in the sort of the low single digits. So that's a kind of mindset that we need to kind of talk to our clients about and say, you've had this fantastic returns. Returns going forward may not be as strong. The other thing that's very interesting in a topical debate right now is sort of growth stocks versus value stocks. So what we've seen tech has had an incredible run in the last 10 years. And we went back and we wanted to sort of see how does this compare historically. So we looked at the Wilshire Value Index and the Wilshire Growth Index. And here what we do is we divide the growth by the value and we get a ratio. And you can see from 1978 to about 1995, you had these sort of 5-year, quite nice, well-behaved cycles. Then we obviously saw 2000, things got out of whack. Obviously, growth stocks did incredibly well, driven by the mania for the dot-com bubble. And then obviously the bubble burst. There's a good 10 years from 2001 to about 2007 for value stocks. And since 2008, 9, it's really been all about growth. So what people have wanted, as we've had a sort of low growth environment, we've seen deflation, people have wanted fast growing stocks to make up for that. And they've obviously bought tech stocks, and we've seen a tremendous rally as tech has really changed our lives. However, when you look at this ratio today, you can see it's quite stretched by historical standards. Apart from the NASDAQ, it's the highest it's ever been. But interestingly, we're kind of seeing a little bit of a reversal. So, we saw a peak, it kind of fell, and then tech's done well. So we're kind of wondering, are we entering a time of regime change where the last 10 years have really been about growth? If you were an investor, if you picked any growth kind of factor or any growthy kind of market, you did very well. So we're wondering, what is the next 10 years going to be like? And is it maybe going to be a value-orientated 10 years? Because we've seen value has struggled, and we've seen that these factors do have times when they have signs of strength and weaknesses, or they mean revert. So that's one thing that we're wondering, and we're keeping an eye on that. So now the Shiller index that I'm going to talk to you about, that we use as a component of the Shiller allocator index, it selects undervalued sectors. One thing we've done is we've gone to look at what characteristics does the Shiller Barclays index have. And this is the underlying equity index, by the way. And what we see is when we run a regression to see if something is value orientated, we see the following. So let me explain the graph to you. We tested 3 indices. First was the S&P value, S&P growth, and the Shiller index. We wanted to see if they were value orientated, and a positive number means you're value orientated. So in the orange line, you can see it's positive between 0.2 and 0.4, and that's what we expect. We expect the S&P value index to have a value orientation. Conversely, in gray, with the S&P growth, it's negative. It's a growth index. We would expect it to have no value characteristics, and hence we see that negative number. And then interestingly, we see that the Shiller Barclays US sector index kind of has a hybrid index. It flips, right? It's dynamic. So you can see from 05 to about 08, it was kind of primarily value orientated as we had end of that bull market. Then it kind of flips around a bit in 08, 09. And then really from, I would say, 2011 to 2019, it's primarily growth oriented. It had 2 sort of flips, but primarily growth. But then interestingly enough, in April and May of 2020, we saw a big flip towards value. So what happened then was we actually started going along some value oriented sectors that were cheap in our eyes. Primarily this was driven by financials, healthcare. And we've seen a tremendous performance from financials, and healthcare has done pretty well too. We've been long communication services and tech, but now tech we're kind of going in and out of. So we're not seeing it as cheap as it was a couple of years ago. So if you think that the market is changing and we could be entering in a new value regime, this index is an interesting, is worthy of your consideration. So what I'm going to do now is, that concludes the talking about the market. I'm just going to very briefly talk about the Shiller allocator index and talk about some performance. So just as a reminder, the Shiller allocator index, it combines a equity index and 4 treasuries. The equity index is the Shiller Barclays sector index that selects 4 cheap sectors every month, and then it combines 2, 5, 10, and 30-year treasuries. combines them using mean variance optimization. So it just kind of says what's the optimal allocation to get a 6% volatility. And very critically, we do have a filter on the treasuries, that if we see that the treasury yield is going up, i.e. Treasury prices are going down, we actually exclude them. We won't go long them because we are worried about what happens if rates do rise. So the key component of this index is the Shiller-Barclays sector index, and we select undervalued sectors. So even though the US market is high at 39, there are pockets of cheapness. I'll give you an example. You know, financials are trading at a single-digit CAPE ratio, whereas some of the other sectors are trading in the mid-30s. Consumer discretionary is one of the most overvalued sectors we see right now. So consumer discretionary has got Amazon, which has a PE of varies anywhere from about sort of 80 to 100, and then it's got Tesla, which the PE varies anything from it's been as high as 1,000 earlier this year. It dropped to 600, and it's back up there after their recent pop in the stock price with the discussion that Hertz is going to buy 100,000 cars for them. So we see consumer discretionary as being pretty expensive. The other sector that we actually see also as being pretty expensive on a relative basis is actually utilities. So what we do with this index, we examine 11 of the sectors. We use the CAPE ratio to find the 5 cheapest sectors. And then we remove one sector using momentum. That's to avoid something called the value trap. So we end up with 4 cheap sectors, and then we equally weight them every month. So what's the long-term performance of this underlying equity index? You can see this index went live in 2017, when the live date. And by the way, the mechanism, we started using the same mechanism in 2012. So this index has outperformed the S&P by about an annualized 2% annually. So it's been pretty strong outperformance by selecting cheap sectors. So year to date on the underlying index, it's up 29%. The S&P is up 24%. Now, what's really driven this? What's the story? So here are the sectors that we have selected for over the last couple of years. I thought that'd be interesting to show. So, what we've primarily been long this last year is we've primarily been long financials, primarily also been long healthcare, consumer services, and technology we've kind of been in and out of this year. So really what's driven our performance has been financials, communication services, and healthcare. Tech, we've kind of been in, we've picked up a lot of the gains. We actually went out of tech in August when tech had a big run up in sort of August. It went up, and then in September it actually dropped. It was about -6%. The Nasdaq drop was -6%, so we kind of missed that. We have not been in energy. Energy earnings have collapsed, so energy hasn't been that expensive, but hasn't been that cheap either. But we did actually avoid utilities, which has just been up 7%. So that's the story of the underlying equity index. And then remember, we combine that with the 4 treasuries, the 2, 5, 10, and 30-year treasuries. So let's look at the long-term performance of the Shiller Allocator Index. What you can see is, firstly, this index is designed for stability. So if you've got clients who are looking for high returns, this is probably not the index. It's designed to be very stable. Now, the reason we believe that is because we use equities and bonds, and they typically move in opposite directions. So the yin and the yang. So they're negative, what's called negatively correlated. So that provides the stability. We weight them to find this optimal allocation, and then we have a risk control feature around it as well. So it's really a stable index designed to be very stable and provide stable and consistent returns. It's also designed to have low drawdowns. So in March of 2020, S&P fell 34%. This index fell about 4.5%. In 2008, when the S&P fell about 34%, this index fell about 8%. So very stable. That's what you're looking for. This is an index worth considering. If you're looking for something that's going to give you those very high volatile returns, this is not that index. So let's take one last step and have a look at the Shiller Allocator Index year to date. So the Shiller Allocator Index is the dark blue. It's up 5%. S&P 5% risk control index is up 7.5%. So what happened? So we've primarily been long, as I said, this equity index takes the equities from the undervalued sectors, and we've been long on average about 40% there. So that's been positive. That's driven some of the returns. We've also had a 44% exposure to obviously fixed income. And that has hurt us. That's detracted from the performance, and you can see the ag is down 1.5%. But I was actually looking at the exposures, and it's interestingly on the fixed income side, the exposure has actually been as low as 0 this year. It's been as high as 70 in the beginning of the year, and then sort of through March and April, May, it was 0. Went long bonds. So we are rotating out of bonds, and that momentum filter is actually kicking in. So if fixed income does continue to perform poorly, we have a way to get out of that with this momentum feature that we see if fixed income is not doing well, we get out. And then we just go into cash. So that's the story of the allocator index. It's very stable, designed for long-term stability. And you'll get a decent participation rate on this index. So that concludes the presentation for today. We're very happy to take questions. I'm going to hand it back to Jason, who will moderate those questions kindly for us.
Yeah, thank you, Lawrence. Great information. Just a reminder, if you have questions, please feel free to enter those into the chat. We will get to as many of those as we can here in the next 10 or so minutes. While we're kind of still on the topic of the index itself, Lawrence, looking at the performance, if you could maybe just kind of recap the main steps and components that you started that portion of the presentation with.
Thanks, Jason. That's a great question. So what we do is this index, every month, the equity index looks at the undervalued sectors and picks up the cheap sectors every month. Every 2 weeks, the index then looks at the equity and treasuries positions and it runs an optimizer. And it just says, I want to find what's the best allocation where I'm always going to have a volatility of 6% and I want to maximize my returns. So that's what we ask the allocator to do, and it gives us those allocations. We do that every 2 weeks. We then observe if treasuries are going down, if there's negative momentum, we take them out the basket, put in cash. And then finally, there is a risk control feature. So there's another risk control feature over the mean variance optimizer to make sure that the index is very smooth and has cushioned returns. And we do that risk control feature, we do that on a daily basis. So just to recap, equity sectors monthly, equities and treasuries every 2 weeks, and then the risk control feature every day. Back to you, Jason.
Thanks, Lawrence. If you could, I believe it was slide 14, if you want to jump forward to that one.
Oh, slide 14, sorry.
Other direction, yep, there you go.
Yep.
Yeah, here we go. So I think you mentioned, I'm looking specifically kind of at the early 2000, March of 2000 drop there. You mentioned the actual numbers. Could you just kind of recap the comparison of the index compared to the S&P during that timeline of early 2000 and then kind of the rebound since then, if you speak to that?
Sure. So this is, so the allocator index so when the markets crashed in 2008, the S&P went down 54%. The underlying Shiller equity index that we take an average of 44% in the allocator went down, just to give you some context, 44%, but the Shiller allocator index only went down 8%. Now it went down 8% because what happens is in a crisis, equities would normally go down, bonds rally as the Fed would normally cut rates. So by the fact that we've got equities and bonds, they're yin and they're yang, and when equities go down, the bonds rallied in 07, and that's why we went down 8%. And then again in the pandemic, if you recall what happened, the equity markets went down 34%, there's panic in the market, the Fed cut rates, as rates go down, bonds rally, they go up. So again, the equities and the bonds, they're yin and they're yang, they negatively correlated, and that's why they went up, and that's why this index went down 4% in the pandemic in March 2020.
Thank you. Let's see here. Got a question about, and I think there was maybe a slide earlier on. Let's see, I believe it was on slide, I don't know if I wrote that one down. You might know which one I'm talking about. There was a spike, there was a graph that had a spike in 2000. I think it was the growth versus value slide.
Okay.
Yep. So the question is, with corrections in the stock market, why 2000 and 2008 look different on this graph, even though there were large corrections in the stock market as a whole?
Great. Yeah, great. Good question. So this is not a stock market index. This is a ratio, and it's the ratio of growth stocks divided by value stocks. So typically you could think about this, if you wanted to simplify it in your mind, you could think about it that this is almost a ratio of tech divided by industrials and financials, because those, tech stocks are always growth stocks. They've got stretch multiples. Value stocks are normally the cheaper ones, and they tend to be, low multiples, such as financials, sometimes healthcare, sometimes energy. Now, what we saw in 2000, we saw growth stocks got tremendously overvalued. So you see the spike. Now, what happened in 2007, 2008, a lot of the frothiness in the market there was kind of driven by financials were overvalued. So we saw that's why the ratio goes down, because it was the value stocks were doing pretty poorly. And we saw financials were the ones that had the big exposures, so they fell, but then the growth stocks didn't do so much. So that's the reason you don't see such a big spike. But the similarity we see today is that, in 2000 you had names like, let's say, Pets.com, Cisco, Amazon were all the hot stocks, and we've kind of seen, and then you're dividing that by, let's say, industrials. And we're seeing a bit of the same thing happening today. You're sort of seeing, today we're seeing the FANG stocks, Amazon, Apple, Netflix, Alphabet, and so on, divided by the value stocks, let's say financials, which are very cheap, industrials, which are cheap. And then you're seeing relative that the growth stocks are beginning to look stretched. So the question is, how much further do we think this can go on? It's hard to know, right? You could keep on going up. It could go up to maybe this ratio. It looks like it's at about 1.4, and then in 2000 it reached 1.7. Could keep on going up, but equally, is the trend broken? We've seen this double head there. We're kind of wondering that what happens is, as you get a new regime coming in, so what we've seen in the last 10 years, for example, industrials and consumer staples, those companies in those sectors have had no pricing power, right? But what you're seeing now is, I referenced the Chinese soy sauce prices going up. That's a consumer staples. We're seeing industrials are putting prices up. There's shortage of chips, so Ford can put up the prices of their cars. They're squarely are an industrial. So we're wondering whether the pricing power is coming back to some of these value-orientated names, and their performance may go, as the value goes up, growth will decline, and we'll see this graph could go down. So we think that maybe these industrial financials, consumer staples may do better going forward.
Thank you. We actually got, while you were speaking on this slide, we got a follow-up question through on this exact one. For the comparison between growth and value, if you could just speak to, I guess, what is being compared? Is it the market value, trading volume, stock price? If you could just clarify that.
It is the Wilshire Value Index, which tracks all the value stocks, and it's the Wilshire Growth Index that tracks all the growth names. And here, this is a ratio where we divide the US Growth Index by the US Value Index. So if they were equally valued, it would be a kind of like a 1. And you can see that kind of on average, it's been about 1.25. So growth stocks have been kind of favored. And what you see is that in 2000, growth stocks were really in favor, and hence the ratio was above 1.5. And then when value stocks are in favor, it's kind of like below 1. And right now we're at 1.3. So we're in an environment where growth stocks have really been favored for the last, looks like since 2007, 2008. It's all been all about growth.
Thanks, Lawrence. You spoke a bit about forecasts in the presentation. If you could just go into a little bit more depth on how you generate those forecasts.
Sure. So what I'm going to do is actually show you 2 slides. So this is the results of our forecasting when we run some regressions. Now, a regression is just sort of simply a way of finding the best fit. Where are we today, and how does that fit compared to the past? That's essentially what we're trying to say. But another simple way to visualize that is actually to go to this graph. And what you could almost simply do is you can sort of say, where are we today? So we are in a CAPE ratio of 39. So we're in the second last bucket from the right, where you see it highlighted in orange. And you can just run your finger across. You can see that with that blue box, that means it looks like it's between 0 and 4%. If I run it across, so it looks like it's at 2%. Now we're at 39, so that means kind of like we're a bit, the box for exactly where we are right now means it's a little lower. But when we run a formal regression, the answer comes up as 4.3. But a simple way to think about that regression is we just simply sliding our finger across this bucket, and the rough answer is about 2.5%. And when we do it on a formal basis, it is 4.3. So I think our key takeaway here is, speaking with Professor Shiller, is that we really encourage everyone to be diversified, because just because the US has had a great last 10 years doesn't mean it's going to be a great next 10 years. You know, we've seen Europe has had slow growth. Maybe they pick up. Japan is looking very cheap. So we just encourage everyone to be diversified when you're thinking about your clients' portfolios.
Thank you. You mentioned early on the Federal Reserve's tapering announcement. I believe you had a comment on that. If you could, do you have thoughts on kind of an outlook through winter and maybe just into Q1 of next year based on that announcement?
Yeah, I mean, that announcement just came out yesterday. So I think we're still digesting that. But, you know, this is my personal view versus Professor Shiller, is I think if you look at a number of respected commentators, I think Larry Summers being one, he says that we really have, you know, in a way, overstimulated. And I think that the Fed has been incredibly worried about sort of making sure that the economy gets going, gets back on its feet. And they've kind of perhaps, you know, overstimulated to make sure we get to that point. And then what they were saying was, you know, we think that inflation is transitory. Now, so I was reading some of the comments, and they've changed their language a little bit around inflation, from saying we think it's transitory to prices might be a little higher than expected for longer. So I think those are some of the key things I would point you at. And actually I would, you know, then go back and say, I think the key thing to look out for with regard to the rates is that the Fed is going to be data dependent. So you've really got to really watch the inflation numbers. And what Professor Shiller thinks there is that he encourages you to think about, is there an inflation narrative, right? Is that taking off? And, you know, it's kind of funny. I had this weekend, I was talking to some friends and the topic of inflation came up. We were just having a loose conversation. So that was kind of interesting to me. So I thought to myself, that's the first conversation I've had at a party about inflation. A little bit boring, but you know, it's coming up. As I said, my hairdresser has put up prices twice in the last year. So if we, the people, start to feel that, you know, then this inflation thing might not be as transitory as we think. So, you know, you at home will be able to gauge that when you hear these kind of conversations with your friends, or if you're buying groceries, you think, that costs a little more than what I expected. So, you know, you can use what information we see at the grocery store and from your friends to pick up the narrative. Back to you, Jason.
Thank you. All right, we will take a couple more questions here. There's actually one that I'll take this one, Lawrence. This is related to what products this index is available on at Athene. So this is available on our Athene AccuMax annuity, which is an accumulation-focused product that features multi-year crediting strategies. So for those interested in where this specific index is available within the Athene lineup, it is on the Athene AccuMax product. So Lawrence, I think we'll take one more that I will kick over to you, and just kind of a good way to summarize the presentation as a whole here. If you could just to do a recap on the definition of the CAPE ratio.
Sure. Oops, I'm just going to go back to that page. So the CAPE ratio stands for the cyclically adjusted PE, and Professor Shiller developed this in the late 80s. And the way we calculate the CAPE ratio is we take the current price of the S&P and we divide it by the average of the 10-year inflation-adjusted earnings. So the traditional price earnings metric is just simply divided by the current price divided by 1-year earnings. So Professor Shiller divides it by the average of the 10-year earnings, and we inflation adjust it. And then that gives us a much more stable metric that allows us to assess if markets are cheap or expensive. And right now, the CAPE ratio stands at 39 in the US market. So that's pretty high. So we use the CAPE ratio to select undervalued sectors, because there are some undervalued sectors. As I mentioned, for examples, the CAPE for the financials is in sort of around about 19 versus the CAPE for consumer discretionary, which is over 50, very expensive. So we use this CAPE ratio to select undervalued sectors. Back to you, Jason.
Thank you, Lawrence. Well, I think that with that, we will wrap things up here. I first of all just want to thank Lawrence for taking time today to conduct this presentation. Thanks to everyone in the audience for taking time out of your day to attend. If you do have any questions as a follow-up, certainly feel free to give our sales desk a call. That's 888-266-8489 or 888-ANNUITY. Give them a call, or your wholesaler will be happy to help answer those. And if we need to reach out to Lawrence for any follow-up questions, we can certainly do that as well. So thanks again to everybody and to Lawrence for attending today, and have a great rest of your day.